Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Joyce and Maddie Radner, both on the Nasdaq Market Intelligence Desk. We're here to discuss key levels to watch in the broader indexes as investors look for a catalyst for the next leg higher. It is great to have the dream team, all Nasdaq, with us today. And Maddie, it seems to be that despite a lot of the uncertainty in the headlines and really being in the sideways trading pattern for the past couple of months, earnings actually turned out to be quite decent.
Yeah, I mean, all eyes are now on earnings as well as tariffs and a lot of the geopolitical uncertainties, but we still have 44 S&P companies to report earnings this week. But so far, the blended earnings growth rate for the fourth quarter currently stands at 16.9%, which is actually a significant increase from just under 12% expected at the end of last quarter. So this will mark the highest year-over-year earnings growth rate since Q4 of 2021. Of the 77% of S&P 500 companies that have reported so far, 76 have beaten consensus expectations according to FactSet, which is right below the 5 and 10-year averages. And 9 of 11 sectors are seeing year-over-year earnings growth. 6 of those 9 are reporting double-digit growth, and 62% have surpassed consensus sales expectations. So it is off to a strong start so far.
Yeah, which is a silver lining, because at the end of the day, it's got to be really tough to project forward guidance when you don't necessarily know what the operating environment is going to look like. Brian, when we think about the market and how it's kind of been in this range, how Trump 1.0 was in the first part of his administration as well. What are you looking at in terms of levels? Because fundamentally, we know we're waiting for a catalyst, right? Whether it's to the up or downside. So what levels are important to watch? And with that, what are your thoughts with the macro?
Yeah, I mean, so with the S&P 500 specifically, we peaked back in late November into early December, and then much of the broader market outside of the mega cap growth went into a 2+ month, sideways trading range with declines depending on which sector of 5 to 10%. And even though in the last week we have made new all-time highs, even today, we were above the prior all-time closing high, which was made in mid-January. We still essentially have been in that sideways chop right around the 6,100, 6,150 range. So that's the resistance. I would call it minor resistance on the upside. If you want to look at the breadth of the S&P 500, we did see in mid-December, during the early stages of the pullback, right around that FOMC, where the Fed was then saying they are now actually going to incorporate future anticipated policy from the administration, and then we saw 1 to 2 rate cuts get priced out. 70% of the index was making 4-week lows. We haven't seen that since 2022, when the market was in a deep corrective move, where the S&P corrected 28%. So it's a really short-term breadth indicator. We have recovered many of those breadth measures. We can see the number of new 4-week lows has been getting lower and lower, less 4-week lows. So that's been a positive. We're trading up against, again, those 52-week highs for the S&P 500. So over the last, let's call it since the beginning of December, we see the Dow is down, the equal weight S&P is down, small and mid caps are down over that time period. S&P is higher, Nasdaq 100 is higher. Really, we think, we were talking about this earlier, mega cap growth stocks are driving that higher, driven by particularly the Mag 7. But that's a really short-term way of looking at it. Right?
Well, it's interesting because, part of the trade was TINA, right? There is no alternative, but you're starting to hear this narrative where people are starting to get interested in what's happening with European and, other global areas of the world, basically because, the upside surprise is there.
Yeah, if you look at the European index, the MSCI Europe index, I have that right up here now. We can see that has been breaking out since mid-January to new all-time highs, and you can see it's been a really wide base from 2021 through late 23. We had a long sideways consolidation. We had the breakout and then the pullback in August of 24, when we were pulling back as well. More recently, this 5-6 week uptrend has coincided with the dollar topping and the dollar getting a little bit weaker. And just to look at one country in particular, look at the German DAX, you can see it's been racing higher as well.
Maddie, I think another area of strength too, we had a couple of decent-sized IPOs last week as well.
Yeah, the IPO market is off to a really strong start. We've seen a couple billion-dollar deals so far, raised 2 IPOs so far this year have raised over $2 billion each. We've seen 46 total deals across the U.S. exchanges. so far this year, which is up from about 30 this time last year. And we're seeing quality deals across multiple sectors: consumer, healthcare, energy. Nasdaq has recently welcomed Smithfield Foods, which raised over $500 million in proceeds. Last week we saw SailPoint come back to the U.S. equity market and raised over $1.3 billion in proceeds. We've also seen a steady stream of healthcare deals come back to the market with Metsera, Beta Bionics, just to name a few.
I mean, the pipeline, I mean, there's over 200 companies on
Yeah.
file as well. Is that just pent-up demand, or is it the wait and see in terms of what the operating environment's going to look like, or was this already on the books prior to some of the uncertainty that we've experienced?
Yeah, we were just discussing on the Market Intelligence Desk, we've had this pipeline of over 200 companies for several months now. So some are starting to go out and new companies are filing, but I think there is a bit of a wait and see kind of attitude right now, just to see where the ones that have decided to move forward have performed. As well as some of the geopolitical uncertainties, see how that is playing out for some of the companies to then move forward.
Anything with your small caps?
So in terms of deal making activity, well, I think for the small caps, a lot of that comes down to the M&A market coming back. And so actually in January, it was the worst market for M&A that we've seen since 2001, I believe. Yes. And it was surprising because
Right.
2025 was supposed to be the year the M&A market comes back, but I think with just a lot of the uncertainties, I think there's, again, a lot of wait and see, but there is definitely kind of more of a positive outlook, and it'll be a longer term driver of small cap performance.
Perhaps the shock is out of the system, if you will. I mean, we knew that policy changes or policy being put on the table, it was going to be fast and furious. I think the pace might have been a bit shocking, and we're just waiting on the execution now. But I think the corporate environment, it's been managed pretty well.
Yeah, I mean, as far as from a stock market perspective, we are holding up well. And you can't be too concerned by very short-term corrective price action. That's what we saw in Q2 of 24, and then the breadth got very strong, very expanded quite well in July, and then again in November. So what you just referenced regarding the new administration, the pace as to which they're moving. There does seem to be every day almost something new that comes out. Vice President J.D. Vance, his speech on Friday was quite noteworthy. We're seeing now headlines in the papers today across Europe about them, the solvency of the EU, whether or not they're going to deploy troops into Ukraine, whether or not they're going to increase their defense spending, whether or not the United States is going to still provide military defense to many of these countries. So it's quite a change of the geopolitical risk that we're normally accustomed to.
Right. And we haven't experienced much in the way of that in quite some time. I mean,
yeah, and
it's been a globalized economy for a number of decades at this point.
Correct. But I think when we went through a period like COVID in 2020, we saw how reliant we were regarding our supply chains to overseas to other countries. Maybe some who maybe we should be less reliant upon. Let me put it that way. So
well, I mean, you can see it in the semiconductor space too. How looking to onshore.
Yep.
More of whether it's just semiconductor supply chain in general. You're seeing that more nationalistic or thinking about security posture.
Sure.
That's one of the priorities as well. I don't think it's necessarily just for America first, if you will, but these are national security.
Yeah, and then going back to what Doge is doing, you would think fiscal spending and GDP is two different sides of the same coin. So will they have an impact on fiscal spend, and will that infiltrate into the marketplace? Again, we're not yet really seeing the big negative impact to the stock market. If that were to kind of play out, there's an expression: things don't matter until they matter. So just something always for us to monitor.
Right. It's always like if your neighbor loses their job, it's a recession. If you lose your job, it's a depression. Right. That's an old one as well. But it's almost like I don't want to call it chaotic, but all of these headlines are coming so fast and furious. It's almost like it takes some attention off of the Fed, which is interesting because they certainly made it clear that they're not in any hurry to cut key interest rates, which I think is a prudent move.
Yeah.
If tariffs put pressure on consumer pricing and so forth, we're going to need to have some alternatives.
Yeah, I think especially for some of the small cap companies, they're going to have to figure out other ways of funding their businesses. But back to the companies who rely on international revenue exposure, FactSet actually came out with some interesting data this morning. For this quarter, companies that generated more than 50% of sales outside of the US actually saw higher earnings growth and higher revenue growth this past quarter. There looks like there's going to be a shift moving forward. Companies who rely more heavily on international revenue exposure are actually expected to report lower earnings growth than those that do not have much international exposure. So there could be a little bit of a shift moving forward with that reliance on international revenue.
Well, I mean, Brian, first quarter typically, there's more unknowns in the first quarter relative to the fourth quarter when you're at the end of the year, because you have some clarity there, right? So, I mean, it's not atypical to be a little bit more prudent or, go a little bit light in terms of guidance in the first quarter, because, 12 months out versus 3 months out it's two different pictures.
Yep, certainly. And the corporate earnings are doing well. I think that as Maddie had noted before with those stats, they're coming in right around those 5-year averages, a little bit better than the 10-year averages. And when you mentioned the Fed earlier, they may not be ready to cut rates at the next meeting, but in Powell's address last week when he was speaking in front of Congress, he did mention something that bank investors really took note of, which was the SLR ratio. There could be changes to that, and essentially what he would say is, maybe we'll modify the ratio so we don't, banks no longer have to include buying or include treasury securities in that ratio, which if they exclude it means they have more room in their balance sheet to buy treasuries. And so that would be a net incremental buyer of treasuries going forward if that were something to play out. And certainly the financial sector, particularly community banks, would be very, I would imagine would respond well to that, because if there's a lot of concern about the debt, servicing the debt, terming out the debt, because we know the prior administration had a high percentage of bill issuance in 2023 and 2024. So trying to figure out how we're going to fund the debt going forward, that would be an incremental positive.
Yeah, certainly. I mean, fiscal policy, I feel out of everything is the most concerning. I mean, relative to monetary policy at this point. All right, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.